So good afternoon, everyone. Today we're going to continue our discussion on portfolio optimization. So let's have a quick review of what we have done so far. Last time we said that the most important uh, packages as far as portfolio optimization is quant mode, QMAO, performance analytics. These ones. There are others that maybe let me see. You have ROI. Maybe we can also do that here. Control C, Control V, ROI, and then ROI dot plug in dot quad prog ROI here dot plug in dot quad prog dot plug in dot happened. Sorry. Dot plug in dot quad prog and maybe other one DE optim. Okay, maybe these three. Okay, try also to load this packages class. We're going to need them for optimization. So this one, I've loaded this, so I won't run it anymore. This one class, okay, loaded already on my part. And DE optim, DEO. Where's that? DE op. Huh? Not yet loaded. DE optimization. Okay, anyway, I'll not restart now. Okay, anyway, we won't get here, but I want you to already load these packages, install and load these packages. Okay, at least these three, ROI plug in that quad prog and DE optim. Okay, once you're done, class, kindly please chat that you're okay. Thank you. Well, let's wait for the others. Good. Thank you, Sheena. Okay, good. So we'll see how far we can go today. In the other section, we were not able to reach efficient frontier. But on Tuesday, we need to already start with machine learning. So maybe I'll ask you to research also on how to generate the efficient frontier, of course, using R, and how does the plot look like? Okay, all right. So let's now begin. Quick review of what we discussed last time. So what we did was to use get symbols from quant mode in order to load some data, some stock prices. And we said that it's important to note that when you're loading an index like S&P 500, for get symbols, you need to put the ticker symbol, the caret, because that's really part of the ticker symbol of the asset. However, when you run this and you download the stock prices of these assets, okay, take note that the name of GSPC does not contain caret. Okay, the object name in our environment does not contain caret. However, when you access it, when you load the data from Yahoo Finance, you have to use this. Okay, so I'll not run this because we have already done that in the past. Now, QMAO, the quick quant mode, the add-on, provides us a very convenient tool for downloading data, and specifically what type of stock price. Here we said that we can use, for example, adjusted, and this will already create a combined adjusted prices of these assets. Unlike for quant mode, for get symbols, what you'll get is the assets themselves containing the data open, high, low, close, adjusted, and then volume, and then adjusted. And then you'll have to do another set of codes in order to extract either the closing, adjusted, whatever you want, and then get the returns. Okay, so it's quite, it's more, what's the term for that? It's more laborious. You have to do more steps, unlike using this add-on where you can already extract the, let's close some of this, the price frame. Okay, let me just close some of the main objects here. Okay, so we did this last time. We created this XTS object containing the adjusted prices of these assets. Okay, now take note, in add-on, you do not put the caret in GSPC. All right, so you can also create this object tickers. Okay, and then notice that I did not put the caret there because I'm going to use it with PF. Okay, and after getting the price frame, let me just run this up to this one, PF1. Okay, so this is our PF1. Okay, so you now have the adjusted prices of all your assets. Okay, but in portfolio optimization, what we are modeling is not the price, but rather the returns. So we will have to do transformation here by getting the diff log of all the columns here, right? And the code that we used is we create this object PF logret. Of course, this is just a name. You can use any name, and it's diff log PF, and then we subset by removing the first column because it gives us NA values. So if I run this, we'll now have PF logret here, and PF logret contains now the returns of the log returns of your assets, which is what we want to model. Okay. All right, let me pause for a while. So far, class, this is just a review. So far, are we clear? May I have your confirmation, class? If you have any questions, please feel free to ask questions. Okay, thank you. How about the others? All right, good. Okay, then another easier, more efficient way is use the RF, returns frame. Okay, the returns frame will give us automatically the returns. And you don't have to download the prices, but rather it will now generate the returns. Still, we identify what price, it's adjusted prices, and what type of returns. It can be continuous or it can be discrete. Discrete is simple returns, continuous is log returns. And even if we use the na.omit is equal to true, still this object will contain the na values. Okay, so that's why we had to subset again and remove the na values. Okay, I will not run that anymore in the interest of time because it's just a review. So when we deal with portfolio optimization, of course, you'll have to define what your portfolio is. So in this exercise, we did not choose all the assets. We just chose, as a basic example, just two. two assets. We chose Apple and Google since they appear first in our data here. Apple and Google. So that's why we had to subset our PF and created this object port 1. Sorry, not PF, but RF. We're modeling the returns. First and second column only. So running this will give us the object port 1, okay, which is this one, which contains the log returns of the first two columns of our RF object. So Apple and Google. Okay. So if you have, unless you have questions, class, because this is just a quick review, just raise your hand. If not, I'll just go through the process. Okay. Now, so we have Apple and Google as our stocks, and the data that we have are the returns. If you want to compute for the portfolio returns, okay, so Apple and Google are your stocks. Your portfolio is Apple, consists of Apple and Google. So when you say portfolio, you're taking it collectively. So if you say core portfolio returns, so you should have only one return for each day, okay, because you're treating Apple and Google as a group, as one. So in order to compute for the portfolio returns, we have to define the weights of the asset. So this initial exercise, this activity, we just use 50-50. Of course, you can choose any other weight, okay? So the function that we're using is return that portfolio. And take note, class, that you cannot use the returns from quant mode like daily returns, okay? Because those are only used for individual assets. If you're using portfolios, class, you have to go through performance analytics and not quant mode, okay? Or nor the other packages that can only handle individual assets. Here, it's specifically return that portfolio. So we define our object to be port 1, the one that we created above, and we define the weights to be 50-50. Okay, so when we run this, okay, and then I'll just continue running here below, plus run this three lines of code. And we now have this object, port 1 ret. And I didn't view it. Oh, port 1 ret here. Port 1 ret here. Let's view this here. Okay, port 1 ret. Okay, you can now see that you only have one column because we computed for the returns of your portfolio by multiplying the returns of Apple by 50% and returns of Google by 50%. Okay, so I hope that's clear, class. And given these returns, we can compute for the average returns for the whole data. So we get the mean of the returns, then multiplied that by 252 because you have daily data. So we are using to convert it into annual data, multiply that by 252. Okay, so we said that oftentimes portfolios will change their weights because the values will change. Okay, the values of your asset will change, so the weights will change. Okay, and if you want still to maintain the weight, let's say at 50-50, then we have to what we call rebalance. So rebalancing can be on a weekly basis, daily basis even, but that will be very difficult and very costly because when you rebalance, you're actually buying and selling. And there are transactional costs, of course, with that. There are taxes that need to be paid. Okay, so here I'm just using monthly rebalancing. Okay, and then same thing, our portfolio is 50-50. Okay, and then here we're creating this object, port 1 rebalance, and we're computing for the portfolio, port 1 50-50, and then the instruction is to rebalance it monthly. Okay, and then let's view this. And then it changed the column name. Okay, so uh, the first month returns will be the same. Okay, the first month return will be the same. What will be different is starting with month number 2. Okay, I'll copy this. January 29, okay, and February 1, Control C, Control D. So this is for the rebalance. For the original port 1 ret, I'll also copy January 29, January 29, this one, and oops, January 29, and February 1. Control C. Okay. As you can see, the portfolio return, okay, 2466587, okay, this is the same, 2 decimal places, and then there's a rounding off here, 5958, they're the same. However, the returns for February 1 is already different. So from February 1 up to the last uh, trading day in this data, you now have different returns. It was only during the first months because there was no rebalancing yet. So when you rebalance starting with February 1, the returns will now be different. Okay, so let's go back here. Let's now create a table which compares the portfolio 1 ret and portfolio 1 ret rebalance. So we're creating this object, all portfolio 1 ret returns. Let's change the column names of all port 1 ret into non-rebalance and rebalance. Okay, because this is your non-rebalance, this is your rebalance, and let's ask R to compute for the Sharpe ratio, annualized returns, all port 1 ret, and then I just changed the risk-free rate 5% because 10% I think is quite high. 5% divided by 252. Okay, so to change it also into daily. And when we run this, we'll see a table comparing the returns for the non-rebalanced and the rebalanced. There you go. So annualized return for the non-rebalance is 20.82%. For the monthly rebalance, it's higher, 20.99%. The risk, standard deviation, the non-rebalance is riskier at 2585. For the rebalance, it's 2576. And the Sharpe ratio, which is risk-adjusted returns, okay, which is your returns minus the risk-free rate divided by your standard deviation, your risk. The higher the Sharpe ratio, the better. So the monthly rebalance seemed to display a higher performance as compared to the rebalance for this specific data set, okay, for Apple and Google. Okay, so we can also use this, the charts.performance summary, a very powerful tool to see the performance of both your portfolio, the rebalance and not rebalance. There you go. As you can see, the green here is your monthly rebalance. And there are points here, many points in fact, where your rebalanced portfolio is higher than your not rebalanced portfolio. Okay, and then I hope you discussed drawdown in your other subjects, but if not, you can check what's the meaning of drawdown. Okay, that's also a very important metric, but we're not going to discuss that here. All right, so let's now go to portfolio optimization. Okay, I hope that review was sufficient. So for portfolio optimization class, okay, I outlined some steps. Step 0 is, of course, you have to define what your portfolio is. In our case, we have portfolio 1, which consists of Apple and Google 50-50, okay, 50-50. And then as I said, the first step in portfolio optimization using R is to create a container, okay? It's a container where we later on will add all the components of your portfolio optimization. Okay, so these are container. So that's the first step. Create a portfolio specification object where we're going to collect specifics about the portfolio. Okay, and then step 2 include will involve you add constraints. Okay, so this is step 2. So here we're adding constraints. So this is our spec container specification. And the next step is to add constraints. We add constraints, and then after that, we add the objective. And then we optimize the portfolio. So these are the steps. And then perhaps last is to create the efficient frontier. Okay, now take note that there could be several objectives. We'll discuss in a while what are the possible objectives. Okay, so let's do this. Let's first create our spec table. So we're going to use portfolio analytics, make sure that it's loaded. Okay, so how to create, this is step 1. Define the specification, or you create your specification object or specification container. Okay, so this is the object that we are using. You can name it differently. For me, I find this useful, portfolio specification, port spec. Of course, you can name it any way you want. And the function is portfolio.spec. Okay, and then we define the assets. The assets is equal to the column names coming from your port 1. Okay, and then we print this, and then we view this. So let's run this first. We have run this in the past already last time, but let me review this. All right, so since we actually had it printed here, port spec 1, we printed it. So what does it tell us? The call is the formula that we use, portfolio.spec. Assets is equal to column names of port 1. And there are 2 assets involved here. But the more complete information is here in the view. Okay, so you have here portfolio spec. You have the name of this object. It's 1 character. And then the type is portfolio. And then assets, we click this. It was obtained from the name of the portfolio 1, right? Apple and Google. Then take note also that there are no elements yet for this one. Okay. Category label 0, weight sequence 0, constraints and objectives all 0. Okay, why? Because we haven't added these components to our container, to our portfolio specification. Okay, let me clear this. And let's go back here. I'll close this. All right, so that's our first step. First step is to create your container, okay, your portfolio specification container. Next step is to add constraints. And we learned about this last time. We said that there are different types of constraints. Okay, you have full investment, which means that the minimum is 1, the maximum is 1, or strictly 1. If you add all your weights, then it should equal to 100%. So the minimum is 100%, the maximum is 100%. Then you have another constraint, weight sum. Okay, weight sum relaxes your requirement a bit, because sometimes, because of this constraint, then it might render no solution. Okay, so personally for me, I don't use full investments. Okay, I relax the model a bit by using weight sum. Okay, so an example of that is the minimum sum could be 99% and the maximum sum could be 101%. So the solution will allow a lower value for the total weight, 0.99, and a higher value for your total weight, 1.01. Okay, that's weight sum. Then another one is box, okay, where you use it to provide the maximum and the minimum weight for individual assets, okay? And also you have long only, which does not allow negative values. Okay, so for example, in the box, maybe let's say, let's do this. Let's say for the box, so we're saying that minimum is equal to, let's say, 0.1, maximum is equal to, let's say, 0.6. So when you have this constraint class, and you know that the portfolio should contain several stocks. Okay, it cannot be only one. Otherwise, that will not be a portfolio. So when you see this min is equal to 0.10 and max is equal to 0.6, that means that all of your assets should have this minimum value of 10% and a maximum value of 0.6%. Okay, let's go here to, if you recall, we opened portfolio analytics. Oh, sorry. Okay, let's do that. Let's seek help for that function. Okay, so add that constraint. Add that constraint. Let's ask R's help for this and see what this will give us. We'll be led to the help function, and then it will show there what packages have this as their function. Only one, portfolio analytics. Okay, good, there's no conflict. Let's click this. Okay, here. So add that constraint class is from portfolio analytics, and it's an interface for adding or updating optimization constraints. Okay, so let's go to the syntax itself. So here, add that constraint to your portfolio, the type, okay, and some other parameters. When you say type, okay, character type of the constraint to add or update. Okay, so you have this, the one that we discussed a while ago, weight sum, box. So there are others, group turnover diversification. Okay, but we're not going to do those. Okay, then, okay, that's it. Okay, but here you're told that the constraint may have several types. It may be weight underscore sum. It may just be the weight, leverage. So specify constraint on the sum of the weights. See this one. So let's click this. What does it say? Okay. So for the weight sum here, we can use this weight underscore sum and then define the minimum sum and then the maximum sum. Okay, enabled is equal to true. All right. So for example, actually the weight sum, full investment is also a type of a weight sum. Here we define the minimum sum is equal to 1 and maximum sum is equal to 1. It's a strict requirement that when you add the weights, it must be 100%. And as I said a while ago, sometimes because of this very strict constraint, then sometimes R is not able to generate a solution. So oftentimes you'll see that the R suggests that maybe you should change your constraint a bit because it's too strict. Okay, imposing that the sum of the weights should be minimum of 100% and maximum of 100%. Sometimes R is not able to generate a solution for our portfolio optimization. Then there's this other type, dollar neutral or active, where you're practically saying that this, let's say this asset has no contribution at all. Okay, because its minimum sum is 0 and maximum sum is 0. in certain instances, this might be helpful. Okay, so here are examples. Here are examples for weight sum. Here you can see type is equal to weight sum. Then this is your mean sum equals 1. This is your full investment, right? Okay, this is your full investment. And this one is full investment itself. Okay, and then this is dollar neutral plus, the one with minimum and maximum sum is equal to 0. And then this is the same active. Okay, so these are our constraints. Okay, let me go back here. Back. Okay, let's take a look at other details. Okay, I want to show this to you. Full investment, okay, dollar neutral. Okay, sum is equal to 0, minimum and maximum sum is equal to 0, opposite of full investment. And then let's take a look at box constraint. So there are some information about this. Okay, type is equal to box. Okay, assets, minimum, maximum. So I want to point this out, class. This one. So our our specification object is this one, PS spec, and then add that constraint to PS spec. Type is equal to box. So you can see here that there are 4 assets in this portfolio. The box will allow us to individually set a minimum or a maximum. Okay, so for example, minimum here, for asset 1, minimum is 0.05. So these are 4 assets, 1, 2, 3, 4. So that's why there are 4 numbers that are given the minimum and the maximum values. Okay, so that's your box type. Okay, let's go here. All right, so let's now add constraints to our model. Okay, so notice I'm starting again with port spec 1 here. Remember, port spec 1 is our container, and in this container we will be putting in the elements of our portfolio. So now we go to add that constraint. Okay, so we're using here type is equal to weight underscore sum, where we define the minimum sum to be 0.99 and maximum sum to be 1.01. And then we also here have add that constraint, same thing. So you're using the same object, the container, the specification object, and then we're adding there several constraints, 1, 2, 3 constraints. Here, it's long only. So when you say long only, it's the same as what class? Minimum sum is equal to 0, maximum sum is equal to 1. So all positive class. Long only indicates that all positive. Okay, and then here class, the box type is equal to box, min equal to 0, maximum is equal to 0.7. Now take note, we have 2 assets, Apple and Google. So which means that there's only one constraint given as far as box is concerned. So 0 will be the minimum for both Apple and Google. Okay, since you're only given 1. So same constraint. And then 0.7 for the maximum is also both for Apple and Google. Okay, so both Apple and Google will have minimum of 0 and maximum of 70%. Okay, so no need here, since it's the same, no need to concatenate this and say minimum is equal to C, 0.0, and 0.0. This is your minimum, and your maximum is C, 0.7, 0.7. So you're saying that both asset 1, which is Apple, asset 2, which is Google will have the same a minimum and maximum. Okay, question, class. So let's suppose this is our constraint. So is it possible for Apple to have a weight equal to 0? Okay, I want you to please write your answer in the chat box. Okay, just want to know what's your thought about that, class. So please chat in the chat box, yes or no. The question again is it possible for Apple to have a weight equal to 0%? Kasi nakalagay dun 0%, di ba? Okay, will Apple have, is it possible to have a 0% weight? Ibig sabihin, walang investment kay Apple. Okay, kindly please chat in the chat box. What is your guess? What is your analysis? So, kay Christian, no. Sige, let's wait for the others. Sorry, Christian, nasabi ko yung answer mo. But Christian says no. And another says yes. Okay. How about the others? So, medyo split yung no din kay, kay Richard. Surprising. Ba't kaya ganun? How about the others? Remember, ang sabi, minimum is equal to 0. Ha? Ayan, no? Yes. Okay. Anyone else? Waiting for the others' reply. Only 3? Yes. Okay. The others, please. Guess lang naman. What's your analysis? Yes. Okay. Okay, Christian, yes. Okay, thank you. Yeah, minimum for the box, yes. Okay. So I only have one wrong answer. Richard, bakit no? Di ba minimum is equal to 0? So pwede, di ba? Richard, could kindly unmute yourself, please? Richard? Kasi isa ka lang na na no. The others,
Yes.
ha?
Opo, sir. Opo, sir.
Why? Is your answer yes or no?
Change na po to yes, sir.
I'll change that into yes. Okay.
Yes.
All right. All right. Good class because the answer is sayang dalawa na sanang tama si Christian at saka si Richard. Kaso they changed their answer. The answer, class, is no. Apple cannot have 0 weight. Okay, why? Simple, class. Simple. If, okay, if Apple's weight, let's say it's WA, okay, WA is Apple's weight is equal to 0, okay, what should be the weight of Google? Given that you have this constraint, okay? The minimum sum should be 0.99, right? And the maximum sum should be 1.01. Okay, so what do you think is the lowest, at least the lowest weight of Google? Kindly chat in the chat box, please. Please chat in the chat box what should be the minimum weight of Google. If Apple, as you said, can have 0, class, what should be the weight of Google? Answer, class? Minimum sum, okay. Christian, paki-share yung answer mo sa ano. Kindly share your answer to the class. Okay, Sheena also please share your answer to the class. Okay, Christian, please. Christian, yes. Okay, Sheena and Christian are correct. If if it's possible for Apple to have 0% weight, then that means that at least Google should have 0.99, right? Because the minimum sum of both class, of course, because this is sum, is 0.99. Okay. However, class, you're forgetting that there's this constraint. You have to look at it from a holistic perspective, class. Yes, we're saying here that minimum can be 0, but actually that's not possible because the maximum is 0.7. So if I assign the maximum, for example, to Google, which is zero point 0.7, then that would mean that at least Apple should be 0.29 to make it at least 0.99. But we have a minimum here equal to 0. Okay, so that cannot be, class. So which means Apple cannot have 0. Okay, if Google is maxed out at 0.7, then at least Apple should be 0.29. All right. Okay, so maybe you'd like to change this. Maybe you can make it minimum is equal to 0.3 and maximum is equal to 0.7 for it to be clear. Okay, although even if we put this, okay, there will be no mistake that Apple will have 0%. Okay, R will not be able to generate a value of weight of Apple of 0% because one of this will be violated. Either the max here will be violated or the mean sum here will be violated. Okay, so I hope that's clear, class. This one, it sets weights to our assets. Remember, in portfolio optimization, what we're looking for are the weights of the assets. And we just have two assets here, weight of Apple and weight of Google. Okay, so let's see. Let's run this now. Let me clear the drawings and let's run this, class. Let's now do step 2, where we add the constraints. This one. Okay. Okay. And after that, let's wait while R is loading the constraints. So here we have 3 constraints, class. Okay, we have the weight sum, the long only, and the box. If I go now to our container port spec, notice now that there was a change. Assets still here, Apple and Google. Constraints now, list of 3. So there are 3 constraints now. Let's see. Number 1, weight sum, and you have a box constraint, okay, because the long only is also a box constraint, and also this another box constraint. So if I show this, class, weight sum, is it enabled? Yes, true. Message false. Minimum sum is 0.99. Maximum sum is 1.01. So there you go, class. This is our weight sum constraint. Okay, and then this is actually the call or the language is add that constraint. Portfolio is equal to port spec 1. Type is equal to weight sum. Minimum is equal to 0.99 and maximum is equal to 1.01. Okay, then let's go to the second constraint here. Okay, it's also a box constraint, long only. Okay, so long only has a minimum and a maximum. The minimum for Apple is 0. The maximum for the minimum for Google is 0. The maximum for Apple is 1. Maximum for Google is 1. Now, why so? Because long only, okay, means positive, positive values only. Okay, so we're not allowing short sales here. Short selling. Kasi ang short selling pwede magka-negative class na weight. Alright? So another way to write long only is minimum is equal to 0. Okay, maximum is equal to 1. Because that will impose that it's all positive. Alright, so that's the second constraint. And the third one is here. Also box. Okay, you have minimum 0 for both, maximum 0.7 for both. Okay, so we now have our container, okay, that contains the assets and our constraints. We have added our constraints. Okay, step 3 will be add the objective. So you have your portfolio spec first, your container, then you add your constraints, then you add your objectives. Okay, so let's quickly take a look at this one. Also from portfolio analytics, add that objective. Okay, let's take a look at some of this one. There are many types of objectives. The most common one is to minimize risk, and another one is to maximize portfolio. What happened here? It didn't run. Control Enter. There. Add that objective also from portfolio analytics. Here, click this. All right. So general interface for adding optimization, objectives including risk, return. So these are the two most popular ones. Okay, objective for risk, objective for returns. Of course, you know that the objective for risk will be to minimize risk, and the objective for return will be to maximize return. And you can have a risk budget, okay, which means that you can say that minimum risk is this much, and maximum risk is this much. Okay, so you can have a budget for risk. All right, so this is the syntax again. Okay, so we have here different types: return, risk, risk budget. You can have quadratic utility or weight concentration. Okay, so you have here examples of add that objective. So first, here in this example, these are data. You can copy this class and copy it to your RMD file, and you can try to run this, okay, so that you can learn also. All right. Okay, so this is the container port F. Okay, this one portfolio.spec, right? Assets is equal to fund names. It's from this one. The fund.names is from the column names of returns. Okay, so we have this data, and then we got the first 4 columns. So after adding constraints, full investment, which means it should be strictly 100%, it should also be positive. Okay, and then here we add this objective. So we're adding to the container port F. The type here is quadratic utility, and then there's risk aversion of 0.25. We'll not be able to discuss this class, but certainly this one class. So here, the type is return, and the name is equal to min. So this is the objective for maximizing returns. This is the object for minimizing risk. Okay, port F, type is equal to risk, and name is equal to standard deviation. Okay, what we're measuring there, what we're minimizing is the standard deviation. Here, what we're maximizing is the return. You can also have other examples. Type is equal to risk, and this is expected shortfall, and this is your p-value. Okay, and then this is a method for that. So I don't know if you studied in your other subjects VAR, that value at risk, and expected shortfall. Okay, so it can be you can create a portfolio that takes those into consideration. Okay, Here we are setting the value of risk to be minimum 0 and maximum at 0.6. Okay, this is also part of risk budget. All right, so you have several examples here. I suggest that you copy this, class, copy this and paste it in your RMD file and then try to run it. Okay, so that's your add that constraint, add that objective. So let's now go here. Okay, our step, okay, where's our step 3? Is adding the objective, this one. So here we're just adding the adding risk, okay? Standard deviation is the name. So this is actually portfolio minimization. What we're asking R is to compute for risk. What is the portfolio that will give us the least amount of risk? Okay, so that's what we're optimizing. So what's the, notice I'm creating this object here, port min var, and it's the same as port spec. Now, quickly, the reason for that is, what I did here was, remember we have already this container, okay? This is our port spec, right? This contains the names of our assets. This contains our constraint. What I did was to create one objective here. Another portfolio, another port spec. See, port min var, which is the same as port spec. So this is port min var. Now, why did I do that? Because I'm going to add a constraint here. Now, why not here? Because if I add the constraint here, then I will lose the original. I will use the original port spec. Okay. If I want to use another objective, then I will have to adjust this because there's already an objective here. Take note, whenever we add something to our container, it will preserve it. So I'm going to preserve this spec, which does not contain objectives, because I'm going to create several specs with a different objective. Okay, so that's the reason why you might be thinking, why did I have to create this other portfolio? Okay, because I'm going to add this objective, which is risk and standard deviation. Later on, I'm going to create another object from port spec, and then I'm going to create another objective, add another objective for that. All right, so here, port min var, minimum variance, minimum risk, okay? All right, so let's run this. And then you have now, if you take a look at port min var, so it's another object. It's not port spec, right? Port spec class is still preferred. It's still preserved. Okay, wait. It's still preserved. The constraints here. Still have the constraints there, and no objective. But port min var now, you have the 3 constraints, and then you have this objective. Okay, you added the objectives here. Okay, and what's the objective class? The objective is portfolio risk objective. Okay, it's the risk objective class, which is to minimize risk. Okay. All right, so we now added the objective. Now we can run our optimization. Okay, so that's step 4 already, optimizing the portfolio. Okay, so what happens when you optimize the portfolio? R creates a solution. Okay, so maybe you should, maybe if you want, you can. I think we already installed TikTok before. Okay, not the TikTok of TOK. Okay, it's the TikTok of counting how long this process will take. Okay, so we're setting that seed because R will do optimization, and optimization will be trial and error. Okay, it will be an iterative process so that we have the same process and the same answer. Because it's possible that if we don't set that seed, we might have different answers. That's possible. Okay, so what's here, class? We optimize our portfolio. The object R is equal to port 1. This is the original object. And then our portfolio is port min var, the one that we created here. So I hope you're getting this. Port min var is the one where we added constraints and objectives. So there's an objective here already. And then optimized method is equal to random. Sir, there are many types of optimization. I told you a while ago to also include ROI, DEO, because these are also methods of optimization. Here we're using a very simple one, the random. Maybe you like to experiment and choose also ROI, etc. So where are we? I'm now here. Step 4. There. Okay. So this is set that seed, and then notice that mean var opt1. Okay, so it's not the port mean var. Okay, it's a different object. Minimum variance optimization 1. Okay, I would like to create this object. Okay, and what does it contain? Optimize that portfolio. R is equal to your portfolio, port 1. Okay, portfolio is equal to the port mean var. Okay, this one contains, this is your spec class. This is your container with the objective. And then optimize method is random. So let's run this, and it will, sometimes the process can take long, but this is just simple. So, okay. It's counting, running. So it's now creating, it's now searching. What R is doing is it's simulating. Okay, what if Apple is this percent? What if it's 28%, or what if it's 50%? What will be Google? And then how much will be the standard deviation? Okay, so it took R around 30 seconds to complete this. Okay, so you now have this object mean var. Okay, let's take a look at mean var. Let's print this. Mean var opt1. Okay, what does it contain, class? All right, take a look at this, class. It contains our portfolio here. Diba? Andito yung assets, andito yung constraints, andito yung objectives. Okay, ito yung port spec natin kasama yung yung objective na risk minimization. However, may dinadagdag dito, no? Ito yung solution, class, weights. Ang weight ni Apple daw is 0.48%, around 48%. Ang weight ni Google is around 50 or 51% approximately. Okay? Ano ba yung objective measure natin? It's standard deviation. And the measure of the standard deviation is around 1.6%. Okay? Ito yung so ang ginawa dito ni R, nag-ano siya ng combinations ng weights, weight 1, weight 2, weight 1, weight 2. And then it computed. Ang bilis, di ba? It computed for the standard deviation. Imagine having to run so many details. Isa-isa natin kukomputin yung standard deviation nan. Ito, 30 seconds lang. Nahanap na niya yung solution na pinakamaliit na risk given the conditions. Given na 0%, 70% yung natin, yung box, etc. So given those requirements, given those constraints, this is the best portfolio that we can get, where Apple should be 48.4% and Google should be 50.6%. And it will give us a risk metric of 1.6%. Okay? So these are your optimal values. Standard deviation is 16%. All right? Elapsed time, yan, 28 point, around 29 seconds. May konting discrepancy dito. All right, so this is your solution, class. So what's the portfolio that will give us the least risk? Ang pinaka-least risk, ito. 48.4% ni Apple at saka 50.6% ni Google. Okay? All right. Pause for a while, class. Any questions? Okay? So medyo ano niyo, class, inamnamin niyo ang tinitingnan natin dito, class, anong portfolio ang magbibigay sa atin ng pinaka-maliit na risk. Okay? Sige, I'll pause for a while. Allow you to percolate the idea. Okay? And see for yourself kung ano yung laman ng mean var opt. I use mean var opt kasi inoptimize na yan, eh, no? Andiyan na yung answer, class. Okay, and once you're done, class, once you have examined it, once you take a look at the answer, please chat yes para I know when to continue. Okay, paki-chat please, class, kung ano kung okay na kayo, ha? So that we don't waste time kasi it's 2:05 now. I only have 10 minutes. Okay, if you're done, class, if you're okay with the result, if you understand now, kindly please chat yes, please. Wala pa, class? Waiting for your feedback if I'm good to go, if I can continue already. Hello, class. Okay, thank you. About the others, please. Okay, good. All right, good. I hope you're able to follow, class. Just to summarize, what did we do just now? We asked R to create a portfolio that will give us the least amount of risk, the minimum standard deviation, given the constraints, given that it should be long only, okay, positive only, that the weight could be 0.99 up to 1.01, and then the maximum should be should be 70% for each. Of course, the answer would have changed if you change the parameters. So R looked for a solution where the risk is minimized given the constraints that we provided. So it will be based on that. Okay. So if the constraints were changed, then perhaps the solution will be different. So let's just take a look at the contents of this optimization object that we created. Okay, I am sorry. We already ran that, class. And these are what's inside mean var opt. And this is just to extract the weights and the measures. Okay, it will just give us the weight of Apple and Google and the measure of the standard deviation. Okay, that one. Okay, now, okay, we can use chart.weights for this optimization object to plot, to create a plot. This is just a horizontal bar chart, class. Okay, this is for Apple, this is 48%, and this is for Google, 50 point something percent. Okay, this is another way. Just change the colors. Okay, but it's the same thing. Okay, just changing the colors. This is the plot of your optimal portfolio given your minimizing risk. All right. Now let's go to, okay. This one, class, I think okay, let me share this with you because I think I failed to include this. Okay, chat in the chat box. Okay, kindly copy this and then let's run it. So what are we doing here? A while ago, we minimized risk. Now, what about if we're going to maximize maximize returns? So here, we're creating this object, portfolio max ret1. I just copied this. I just not copied. I just gave this my name. Okay, you may change the name if you want. You know that class. And then we're using the container port spec1. So that's the reason, class, why I wanted to preserve this, so that anytime I can access this. Okay, so I'm creating a new portfolio, and then we add the objective. Our portfolio is this one, port max ret1. The type is return. The name is min. So what will happen now is R will look for a solution, look for a portfolio where the returns are maximized. Okay, this is portfolio maximization. Okay, the other one, the one a while ago, is portfolio minimization. Okay, risk minimization, return maximization. Of course, it cannot be otherwise. All right. So this is adding the objective, and it's all placed into one. This is optimizing the portfolio. Okay, I should have maybe I should have okay, I think I should have used opt here. Okay, let's change this. Max optimization. So this should be optimization. Okay, and this should be optimization. And then this should be optimization. Okay, let's change it, class, so that it's distinguished from the port spec with the objective. Okay, so take note again, class. Okay, this is what we did a while ago. I just combined it into one code chunk. First, I copied the port spec. Then I added the objective, which is to do the returns, the mean. Okay, and then I optimized the portfolio using random method, and then I extracted weights. Okay, so let's run this. All right. So we have, what we need is the port max. Where's that? Port max opt here. Sorry, what's that? What object did I use? Wait. Port max opt not found. Oh, wait. Port max opt not found. Port max. So, wait. Okay. I should have, okay, sorry, I missed something here. So port max opt 1. Sorry for that. Alt minus should be our port max ret1. Okay. What's happening here, class? Port max ret1 has the objective already. So I'm creating this object port max opt1, which has the objective. Okay. And then because the optimized portfolio needs something that has the objective. Okay, so this will now run. Sorry about that a while ago. Run. Okay, all right. You now have this one, class. This is port max opt1 here. I'll run this. I'll view this. This is our optimization class. Port max opt1 view. Okay, here. Okay, take a look at this class. So this is our solution. You notice this is the portfolio class. Okay, this is the weight. So in order to generate the maximum returns, you should have 70% Apple, and 31% Google. Notice the sum is 101%. So this is okay, class. Okay, the objective measure is the mean, and the mean is 0.0009. So this is the 0.00, that's 0.0956%. This is the return, class. This is the return. Of course, it's small because this is daily. Okay, you can multiply this by 252 to make it annual. Okay, optimal values, class, mean here. Okay, etc. So we were able to generate that ito class, extract rates, that the solution for maximum return is 70% Apple and 31% Google. And the metric for the return is 0.095% stock return, daily returns, class, daily returns. Okay, so there's also an example here. There's one with rebalancing. There's one class where here, I think you have this also, okay, where we combined. So kindly look for it na lang, no? Sorry, so we were not able to reach efficient frontier, but you can look at several combinations for your portfolio. But what's important is that, let me quickly summarize. In creating an optimal portfolio, you have to, of course, choose your object, create your object, and then create your container, create your specification, add constraints, okay, add the objective, and then optimize the portfolio. And you can plot it, okay. And the efficient frontier, class, what's the efficient frontier? The efficient frontier, and this is part of your requirement. First annotate here, it's here. The last part of your paper includes generating your efficient frontier. So what's your efficient frontier? So it looks like this one, class. There. And it contains different combinations of weight here. Weights. So these are portfolios. Okay, 50-50, 30-70, etc. These are all portfolios, different portfolios. And the efficient frontier tells us that the best portfolio are in this region here. This region. And why is that so, class? Why is it that the best portfolio are in this region? Here, in this line here. There. Because, okay, take a look at this. This is, let's say, portfolio 1. This is portfolio 2. Notice, class, that if I drop a line here, okay, this is your risk, sigma. This is your risk. This is your returns, okay? Your returns R bar. Okay. Between portfolio 1 and portfolio 2, you notice that portfolio 2 has the higher returns compared to portfolio 1. And at the same time, they have the same amount of risk. Diba? Same amount of risk, but portfolio 2 has a higher return. Okay, so those that are outside this line, class, are inefficient. Only those that are in this line, okay, are efficient. So this is why it's called efficient frontier. Okay, even those that are below here, they're worse performers, and those that are in this line. Okay, so the best performers are in this line. So it depends. For example, if you're an investor, what is your risk appetite? Okay, I can take only, let's say, this amount of risk. So if you're only okay to this amount of risk, then your best option is this portfolio. So this portfolio has the weight for Apple and weight for Google. So that's your efficient frontier, class. Okay? All right. So that's part of your case.